There's something weird happening to the index fund market that I've only just realised recently, and I'm seeing it more and more. And I'm going to call it the rise of the fake index fund. So the issue is that the index fund, or at least what I mean when I talk about index funds, should be passive, well diversified, low cost, and pretty much things that follow the stock market as it was intended. But I think John Bogle would be turning in his grave with what we have at the moment because we've got a right mess on our hands.
Concerned, angry, astonished.
For example, let me show you what I mean, and specifically these ones are ETFs, so these are the ticker symbols that you can look up. Now, if you live here in the UK, here are some that you might know. They're all technically index funds. You've got this one, and then this one. Then from a US perspective, here's three more. You have this one, and this one. All of them can be classed as index funds, but I think there's definitely some imposters here. So let me explain why, and then also show you why you need to be maybe a little bit more careful about what you choose to invest in.
Don't listen to him. He's an imposter.
First though, a very quick history lesson on index funds. They haven't actually been around for that long, and the legendary founder of Vanguard, John Bogle, often called Jack, was one of the pioneers who actually created them and brought them to the market in the late 1970s. Now, they only started off with around $10 million invested in them, and actually took quite a long time to get a lot of interest.
It took 20 years until the mid 90s,
right,
for it to begin to gain real traction. And then it accelerated, and the growth from 1995 to 2016 has been astonishing, and it's sustained.
Funny enough, there were a lot of bad press against Vanguard and index funds generally, as all of the people in the financial industry didn't like the fact that index funds had really low fees. And what's the way that the finance industry makes all of their money? You guessed it, fees. And that's something that we can touch on shortly too. Now, just going back to the history of index funds, the growth has been massive over the past couple of decades, and they now have reached a point where under trillions of dollars are under management inside of these index funds. And they have now recently overtaken actively managed funds by total amount invested. Have a look here just how quickly this has happened, and you can clearly see the unstoppable rise of the index fund. But what's causing the change to what I'm calling fake index funds? Well, have a look at this. Here's how management fees have dropped in the investing industry as much more people ditch expensive funds. So the industry is trying to find ways to get their fees up and come up with more and more products to get you to buy. So here's where the heist begins. The issue we have now is that so many funds have now all been lumped under one umbrella, the index fund. But really, they're just hacking the name and making it up as they go along. So let me show you what I mean. If we go back to the example earlier from the US funds I mentioned, let me take SCHD. It's a really popular ETF over in the US that focuses on high quality companies that pay a dividend. It's listed as an index fund because it tracks an index. And on the fact sheet, we can see that the index it tracks is called the Dow Jones US Dividend 100 Index. Right, so what's that? Quick Google and you'll find what it is. It's just one of hundreds of indexes that have been created by the company S&P Global. They're similar to the likes of FTSE Russell, who create indexes for ETF providers to track. I guess you could say if we compare this industry to professional sports, people like S&P Global and FTSE Russell are kind of like the Football Association or the equivalent managing body, and they track all the teams inside of them and decide who might want to go into each league. Anyway, back to the index fund. The Dow Jones US Dividend Index is made up of 100 stocks, and if we check the fact sheet, we can see that they're actually selected by passing a screener. Nothing too complicated here. They need to pay a dividend and have done that for the past 10 years, have a market cap of at least $500 million, and then also have enough daily volume above $2 million for the past 3 months on average. After that, the stock also again gets arranged by using the formula here, where they now look at all of their financials. Now, on the surface, this is fine. There's nothing wrong with this at all. The issue is that this fund is still technically a passive index fund because it's not being actively managed by a manager who decides when to buy and sell the companies inside of it. But when we compare this to what index funds used to be, this is where the biggest issue comes up. You see, when Vanguard created the index fund, you pretty much had only one choice. It was an S&P 500 fund that was purely based on market cap weights. The bigger the company, the larger share of the fund that got invested. No fancy screens here, this is as pure as you can get. Now, as time went on, they created other indexes, like for example, the whole of the US market and then even the whole of the world. Again, all based on market cap weights. Now today, you have hundreds and thousands of indexes that track every country in the world, every kind of stock, every kind of factor like quality, growth, value, you name it. And while choice is great, I do worry that just like when you're sat down browsing on Netflix, trying to figure out what to watch, too much choice might actually be an issue. Remember that the index fund took off and got popular for two major reasons. Firstly, it was a really low-cost way for an investor to own the whole stock market. The fees were extremely low compared to other mutual funds at the time, and these costs over time make a huge difference. And then the second reason was that most of the actively managed mutual funds and smart money managers couldn't even beat the returns of the market as a whole anyway, even before you have to take off their expensive fees. And let me show you here just how much of these savings have added up over the years. So it's no wonder that we now find ourselves in a place where every financial institution is trying to create loads of index funds and ETFs that really, in my view at least, are starting to roll over into more of an active strategy. And while there's nothing wrong with that, I do think that it confuses the whole idea of what an index fund is meant to be and what passive investing is all about. Now, at its heart, it's not about trying to time the market, find the hot sector or the right country. It's about owning the whole market and enjoying the returns over the long run. John Bogle put it best when he called it owning the whole haystack rather than trying to find the needle in the haystack, which would be the amazing companies that give you those huge returns like Outliers, Amazon, Google, Tesla, you name it. If we just look at another example that I mentioned earlier, even close to home, even Vanguard have lots of index funds that follow different sectors. Now just take VHYL as an example, which is a really popular one here in the UK, especially for dividend investors. Again, if you dig into it, you can see that this one follows an index too. Now this one's called the FTSE All World High Dividend Index. And again, if you go digging, you can find out how the index works and what it really looks for. It's basically looking for all large cap and mid cap companies, taking out any real estate investment trusts, and then sorting them by their forward dividend yield. Now, is that a good way to do things or not? Well, who knows? Until we see the long-term performance, at the end of the day, it really all depends what you want as an investor. But hopefully you see the point here. Now, you can run the same process with hundreds of different indexes that are tracked by the different indexing companies out there. Now, some of them have a lot more of a complicated screening process than others, yet all of them can technically be called index funds because they track an index. So what's the solution here, and how big a problem do I really think this is? Well, look, as usual, it's a careful balance that we need to strike here. The finance and investing world can only exist if they generate money in fees. Now, these fees come in all shapes and sizes, and we know that over the past few decades, they've been squeezed really hard by passive index fund investing. Now, funny enough, Vanguard especially keeps reducing their fees, and in the US at least, some of their funds have such low expense ratios that the margins make no sense for new companies to try and get some of that share. It only works when you have a huge amount of money under management. So what did the market do in response? Well, they look for ways to make more money. And their solution was to create lots of these indexes in smaller areas of the market and then raise the fees to account for this. And like I said earlier, I'm all for having lots of great low-cost choices for people to pick and choose investments that are right for them. However, some of the indexes are clearly just out to grab money and chase trends. And unfortunately, new investors still fall into the same traps time and time again. For example, do we really need a metaverse index? There are now multiple companies that have made indexes for ETF providers to track this area, no doubt because it was a hot topic and lots of people were searching for ways to invest in it. It's the exact same with artificial intelligence too. Don't worry, if you can think of a sector, there's an ETF there ready to take your money. And have a look out for those fees. Now, while they're not ridiculous by standards of the past, a lot of these funds are around 0.5% per year and even more to invest in them, which is anything from double to 10 times the cost of a global or even an S&P 500 index fund. Another thing I've noticed is that there's so many ETFs out there that have very limited history. They've only been going for just a few short years, so it can be really hard to compare them, at least from a performance perspective. You can bet that in the future, a lot of these ETFs won't even exist, either because they aren't making enough money in fees, or they just aren't that popular anymore, so they'll probably get bought or merged with another fund somehow, even just to give their investors their money back. So let's be honest, is this a major problem for investors? Maybe not quite yet, but does it make things more complicated and confusing? Almost certainly yes, in my view. I know when you first start investing, you try and get your head around what an index fund is, and now you have all of these things that are all kind of in the same category. It's like going food shopping for crisps, but now you have a whole aisle of every possible flavour and shape. You know that they all are technically crisps, or chips as our US viewers will call them, but some are Pringles and others are shaped like monsters' feet. Now, some of them will taste pretty good, and others are probably not going to be around for a very long time. Here's John Bogle in an interview when he was asked about what his thoughts were about how the industry has taken the index fund and made it their own. Listen to this.
Concerned, angry, astonished. There is a fringe element. It's almost entirely in the ETF industry. That's a marketer's dream. People that have no background in the business, Henry Kaufman calls them financial buccaneers, come into the business with a hot idea, and they want to sell. I won't name any names. They want to sell what's ever hot. And you've read interviews with these managers in Barron's, kind of frightening. And they say, well, I know that, so we'll think of something else when they fail. Is that the way to be in this business?
So what do you do then as someone who's in this imaginary supermarket with all of these index funds? Well, you've just got to go in there with a list and stick to it. Be really careful about picking and choosing, jumping from one trend to another, or making your portfolio too complicated, because as I know from experience, it just makes things harder to manage, and it means you're way more likely to stop investing or sell out when things start to look down in the market. For most people, it's better to keep things simple. Stick to a traditional kind of index fund, something that covers the whole world, or at least most of it, and then keep holding that, investing that for a very long time. Now, nothing's guaranteed. I'm not a professional financial advisor, and there's always risks, of course, but at least you won't get hit with high fees. Now, if you do want some help trying to figure out what to invest in, you might find this next video useful, where I go over whether the S&P 500 or the world is the best index to invest in. Anyway, see you in the next video, and as always, happy investing.